We're going to have to go live to Abuja now, where the executive chairman of the Federal Inland Revenue Service is holding a press briefing in Abuja on the ongoing legal battle between the Federal Inland Revenue Service and Rivers State government on the right to collect value-added tax. Let's listen in.
The sharing and allocation that the portion that falls to the federal government goes to the relevant consolidated revenue account. As to the incidence of VAT, VAT is practiced on an input-output mechanism. And what do we mean? What it means is that for a business, either importing or buying products for resale, that business will pay VAT, either at the port if it's importing, or to the manufacturer if it is buying from a local manufacturer. And when that business pays VAT, it is accounted for that business as an input tax, such that when it begins to sell in any part of Nigeria and charges VAT to its own customers, it is able to recoup the input tax paid either at the port if it's an imported item, or paid to the manufacturer if it is an item bought locally. And it works only at a national level. VAT cannot work at subnational level. And there is no country in the world where VAT works at subnational level. And the reason is because VAT depends on the input-output mechanism. And just to illustrate this, for example, assuming a business person bought an item, let's say in Osun State, and paid VAT, and takes the goods to, let's say, Sokoto State to sell. Remember, this business person had paid VAT when purchasing the product in Osun State. And when selling in Sokoto State, it will charge VAT. And by the operation of the input-output mechanism, this business person will deduct the input tax paid in Osun State from the output tax charged in Sokoto State and remit any difference to the relevant tax authority. In this case, because there is a single tax authority handling VAT, it is the same authority that received the VAT in Osun State that will receive the additional VAT payable in Sokoto State. And so it is easy to work out the input-output mechanism, and there is no issue of the business person being shortchanged. There is no issue of consumers having to pay VAT more than once. However, if this is operated at subnational level, that is, let's say at the state level, it will mean that when the business person is paying that VAT at the state of source, and we have said, assume it's Osun State, Osun State Revenue Authority will have collected that money. And then when this business person is selling that same item in Sokoto State, it will charge VAT. Now, the dilemma is, how does that business recoup the VAT paid previously? Either of two things will happen. Either Osun State will have to refund the VAT collected, or Sokoto State will have to absorb that loss. And that in itself creates confusion. Another problem that will arise is where there is difference in rates. If, for example, Osun State charges VAT, let's say at 10%. Sokoto State charges VAT, let's say at 5%. And so, at the point of procuring the goods, this guy will have paid VAT at 10%. But when he's going to sell, it will only charge VAT at 5%. As such, the input suffered is greater than the output. Then the question is, who bears the shortfall of 5%? Will you go to Osun State to collect that 5%? Or will you ask Sokoto State to reimburse the merchant of 5%? So you will find out that these two reasons are why it is extremely difficult, if not impossible, to operate VAT at subnational level. And that is why there's no country in the world that does that. I know that people could say, but what happens in Canada? Canada is equally a federation like Nigeria. But the GST, that's goods and services tax, which is equivalent to VAT that is done in Canada, even though it's meant to be state tax, is administered centrally by the Canadian Revenue Authority. And the revenue, based on agreed and based on the law, is shared to the relevant state. I think only one state in Canada does not participate in that scheme. And that state that doesn't participate does not charge VAT. Somebody could say, what happens in the US? US has 50 states. US does not practice value-added tax at all. It's one of the very few countries of the world that doesn't do VAT, either VAT as VAT or GST as GST. What happens in the US is what we call sales tax, and it is administered at each state level. And it doesn't operate on an input-output mechanism. And it is not every state in the US that charges sales tax. There are some states where you pay sales tax. There are some where you don't pay sales tax. And the rates are also different. And there is no need for input-output mechanism. And there are quite a number of states in the US that doesn't even charge at all, based on their own preference, wanting to attract businesses to their state. I think the other thing I want to say in respect of administration of VAT in Nigeria is that when you look at the VAT that comes, revenue that comes, there are three very important avenues that VAT accrue, and very significant. One is VAT on imported items, which is collected at the port of entry. As of today, there's no single state government that controls any port in Nigeria, which is why it becomes a lot easier for the FRS, being a federal government institution, to administer VAT at the port. The second very important source of VAT in Nigeria is the one that we pay when we buy things, which is what happens when you go to any of the shops to buy things. And the third category, which accounts for a substantial amount of VAT collected, is VAT paid by ministries, departments, and agencies of government when contracts are awarded, either contract of supplies or contracts for construction. And that is why when you look at the numbers of VAT collected today, after Lagos, because we have so many ports in Lagos, FCT comes second, because majority of contract awards are from federal ministries, and VAT collected in respect of those contracts are from federal government. So at the end of the day, when we begin to do a critical statistical analysis of collection of VAT revenue, you would discover that what comes from in-country trading, when we go out to buy things here and there, takes not a very substantial proportion of revenue collected from VAT. But notwithstanding these diverse sources of VAT, VAT revenue is still shared 85% to the states and local governments and 15% to the federal government. I think I will stop here unless there is any other specific question. just to be clear as to how VAT is administered in Nigeria. Thank you.
Thank you very much, sir. I'm sure there will be other questions directed to you, sir. Sorry, let's take the second question from the lady from Business Day.
Good afternoon, sir. Second question.
Go ahead.
How was the FIRS able to generate 1 trillion naira from VAT in the first 6 months of 2021? And what efforts is being put in place to improve on production?
Okay, first and foremost, we deployed technology, and what did that achieve for us? It enabled us to block leakages that were hitherto present in tax declarations and then coming up with the liabilities. And what is that technology that we deployed? Is Tax Pro Max. That is our own in-house developed tax administration system. For the past 10 years, we have been trying to achieve an non-human intervention in tax administration from end to end. And we've deployed many third-party technology or tax administration solutions, which still left us with gaps that we were running like a mini manual or semi-automated system. So what we have done now with Tax Pro Max is that we are managing the life cycle of a taxpayer using technology. From the time a taxpayer registers up until the time, because the ultimate is the taxpayer getting their tax clearance certificate. Now recall that in the past, when a taxpayer is registering as a taxpayer in order to be issued their tax identification number, you typically will bring your CAC registered documents, your CO7 listing your directors and all that, but we don't have to do all that now. So a taxpayer can actually go online and register online, and then we do that validation online too, because we have integrated with Corporate Affairs Commission, and then check the validity and authenticity of the taxpayer. And then thereafter, the taxpayer can then start filing their returns and then entering all that they need to enter in their declarations. Now, another aspect of what has happened, again, as a result of deploying Tax Pro Max, is what is important to a taxpayer is when they are paid or when they issue contracts and they are paid, the payee automatically deducts withholding tax from the taxpayer and remits it to FIRS. Now, receipts are issued to the taxpayer, which they then take also manually to the FIRS, who then issue them a credit note that they can use to offset their tax liability. Now, that is also automatically done. So once the MDA or whomever the payee deducts that withholding tax and remits to FIRS, a receipt is automatically generated, which goes to the email of the profile of the taxpayer. Now, once that receipt is generated, the system also recognizes that a withholding tax receipt has been generated and converts that to a withholding credit note, which then becomes a credit in the ledger of the taxpayer. Now, when the taxpayer therefore goes to file their tax, at the end of the declaration or submission of what they need to submit in all the schedules, it then prompts the taxpayer, after he validates and accepts that the declarations of the summary of the declaration is correct, and they accept that, it requests from the taxpayer if they want to use the credit in their ledger. If they say yes, let's assume the tax liability is 100 million and they have 85 million or whatever the amount is. It deducts that and then presents 15 million for the taxpayer to pay. It therefore also gives you the option to pay at the bank or to pay right away. If you click to pay at the bank, a document reference number is generated, which you then print and take to the bank. When you go to the bank, that's all you give to the bank teller to process your payment and issue your receipt. If you also choose to pay right away, it presents to you different payment gateways. You choose the one that you prefer, and then you pay online. So in other words, we've been able to achieve and end-to-end processing on the life cycle of that taxpayer from the time the taxpayer registered and up on the time they pay their tax liability. Now, having made these payments, the next thing the taxpayer would want also is to request for their tax clearance certificate, which is a statutory requirement for most of the agencies that give contract, if not all of them. So you then have to go and apply for your tax clearance. So those days of going to the tax office and applying for tax clearance to be issued are gone. So you go online again. Now you're already a registered taxpayer. You enter your TIN number and then go through the process of applying for your tax clearance certificate. Most times, if the tax controller who is supposed to do the approval is available online, he will approve. So you can even say between 10 minutes to probably at the max 2 days, you will have your tax clearance certificate sent to your email. That is the email that is registered with the taxpayer, and then you can print it and use wherever you want to use. So that's how FRS has been able to block leakages, and we're able to actually earn more from the, get more taxes from the taxpayers, because the issues of under-declaring and under-payment, we've been able to overcome that challenge. Thank you.